12 months ago, a couple in Brisbane bought their first home with $38,000 saved. Not $200,000. Not $100,000. $38,000. On a $760,000 house. That is a 5% deposit. And they paid zero lender's mortgage insurance. And they did it completely legally, using a government scheme most Australians have either never heard of or don't fully understand. Today I'm going to show you exactly how that works, the schemes available right now in 2026, who qualifies, what the catch is, and the numbers you need to know before you decide whether a 5% deposit strategy is actually the right move for your situation. Because here's the part most content on this topic skips. A 5% deposit is not automatically the best decision just because it gets you in the door faster. For some buyers it's genuinely life-changing. For others it quietly costs them more money over the life of the loan than waiting another year would have. Knowing the difference is what this video is about. Let's start with the problem the scheme was designed to solve. Because understanding the problem makes the solution make sense. To buy the median house in Australia today without any government assistance, you need a 20% deposit to avoid lender's mortgage insurance. On a median house price of approximately $1 million nationally, that's $200,000 in savings before you can touch the market. For the average Australian earning around $98,000 a year, saving $200,000 after tax, rent, and cost of living takes approximately 8 to 10 years of disciplined saving. In a market that has historically grown faster than most people can save, that moving target is what locked an entire generation out. The government created the Home Guarantee Scheme specifically to break that equation. There are currently 3 guarantees operating under the scheme in 2026. The First Home Guarantee, the Regional First Home Buyer Guarantee, and the Family Home Guarantee. Each one works differently and targets a different type of buyer. Let's go through all 3. The First Home Guarantee is the flagship. It allows eligible first home buyers to purchase a property with as little as a 5% deposit, with the federal government guaranteeing up to 15% of the property value to the lender. This means the bank treats the loan as if it has a 20% deposit behind it, even though it doesn't. No lender's mortgage insurance. No LMI premium. To qualify in 2026, you must be an Australian citizen or permanent resident. You must be buying your first home. Your income must be under $125,000 as a single or $200,000 as a couple. And the property must be under the price cap for your state or territory. Those price caps matter enormously and most people don't know them. In New South Wales and the ACT, the cap sits at $900,000. In Victoria and Queensland, it's $800,000. In Western Australia and South Australia, the cap is $700,000. In Tasmania and the Northern Territory, it's $600,000. And in regional areas of most states, the caps are lower again. If the property you want costs more than the cap for your state, the guarantee doesn't apply. That's not a loophole. That's a hard boundary. There are 35,000 places available per financial year under the First Home Guarantee. They are allocated on a first-come, first-served basis through a panel of approved lenders. Once they're gone for that financial year. The Regional First Home Buyer Guarantee works identically but is specifically for buyers purchasing in a regional area, not a capital city and not a major regional centre as defined by the scheme. There are an additional 10,000 places available annually for this stream. If you're buying in regional Queensland, regional Victoria, rural New South Wales, or similar, this is the stream worth checking first. The Family Home Guarantee is different in a critical way. It's not limited to first home buyers. It's available to single parents or single legal guardians with at least one dependent child who want to buy or rebuild a home. The deposit required under this guarantee is just 2%, and the income cap is $125,000. There are 5,000 places available each financial year. Now here's the myth bust this topic desperately needs. Most people think the government is handing them money when they access this scheme. They aren't. The government is guaranteeing part of your loan to the bank. Not paying it. Not gifting it. If you default on the loan and the lender suffers a loss, the government covers the gap, not you. But you still owe every dollar you borrowed. The scheme removes the LMI cost and lowers the deposit barrier. That's all it does. And that's genuinely valuable. But it doesn't change the size of your loan. It doesn't change your repayments. And it doesn't change the fact that on a 5% deposit, you start with 95% debt. That distinction matters for what comes next. When you buy with a 5% deposit, your loan-to-value ratio starts at 95%. That means property prices don't need to fall much before you are in a position where your mortgage is worth more than your home. In a market that has been broadly rising, that risk has been manageable. But in a city or suburb where prices are flat or slightly declining, like some areas of Melbourne, Canberra, and Hobart in 2026, buying at 95% LVR requires a genuine risk assessment before you commit. The numbers in that scenario look like this. You buy a $700,000 property with $35,000 deposit and a $665,000 loan. Prices fall 5% in your suburb over the next 18 months. Your property is now worth $665,000. Your loan is still $665,000 minus whatever principal you've repaid. You're at or near break-even. Prices fall another 5%. You owe more than the property is worth. That's not a reason to avoid the scheme. It's a reason to choose your property and your suburb carefully before using it. The areas where 5% deposit buying is strongest are suburbs with genuine population growth drivers, tight rental vacancy rates, and infrastructure investment underway. The areas where it's weakest are overbuilt apartment markets, single industry-dependent regional towns, and suburbs where the local economy is contracting. Buy in the right place at 5% and the scheme is an extraordinary lever. Buy in the wrong place and you've accelerated your entry into a difficult position. Now let's talk about the other costs most first-home buyers don't factor in until it's too late. Because the 5% deposit is not the only cash you need at settlement. Stamp duty. In New South Wales, on a $900,000 property, stamp duty for a first-home buyer is approximately $34,000 after concessions. In Victoria, on an $800,000 property, a first-home buyer pays approximately $43,070 after concessions. Queensland charges approximately $21,850 on an $800,000 purchase. Western Australia, South Australia, and Tasmania have their own rates and first-home buyer concession thresholds that differ significantly. Some first-home buyers quality for stamp duty exemptions entirely, particularly for properties under specific thresholds. In Victoria, properties under $600,000 are fully stamp duty exempt for first-home buyers. Between $600,000 and $750,000 there's a partial concession. Above $750,000 full stamp duty applies. In New South Wales, first-home buyers can choose between paying stamp duty upfront or opting into the annual property tax, a relatively new option that may suit buyers who plan to sell within a few years but creates an ongoing annual cost that continues until the property is sold. Beyond stamp duty, you need to budget for conveyancing and legal fees, typically $1,500 to $3,000. Building and pest inspections, $500 to $800 per inspection. Loan application fees depending on the lender, $0 to $800. Moving costs, $1,000 to $5,000 depending on your circumstances. And potentially a buyer's agent fee if you use one, typically 1.5 to 2.5% of the purchase price. On a $700,000 purchase in Queensland with a 5% deposit, your full cash requirement at settlement might look like this. Deposit, $35,000. Stamp duty after concessions, approximately $21,850. Legal fees, $2,000. Inspections, $700. Lender fees, $500. Moving costs, $1,500. Total cash required, approximately $61,550. That is dramatically different from $35,000. And many first-home buyers discover this gap too late to do anything about it in the settlement timeline. The practical preparation for a 5% deposit purchase therefore looks like this. Save your 5% deposit plus at least an additional 5% for purchase costs and a buffer. That means a buyer targeting a $700,000 home genuinely needs $70,000 saved before they start the purchase process, not $35,000. Now the strategy question most first-home buyers never ask. Should you actually use the 5% deposit option, or would you be better served by saving longer and borrowing less? The answer depends on two things: your local market trajectory and your borrowing capacity relative to your target price. If the market you want to buy in is growing at 8 to 10% per year, which Brisbane, Perth, and parts of Adelaide have been doing, then every year you wait costs you approximately $64,000 to $80,000 in capital growth on an $800,000 property. The cost of waiting to save a larger deposit is enormous in that environment. If the market is flat, which parts of Melbourne and Canberra have been, the urgency to get in with 5% is much lower. The cost of waiting is smaller, your deposit grows faster relative to prices, and your starting LVR will be more comfortable. Run the numbers for your specific market before you decide. Not the national average. Your suburb. Your price point. Your savings rate. Your timeline. There is also a third option most first home buyers never consider. The guarantor loan. A family member, typically a parent, uses the equity in their own home as security to guarantee part of your loan. This can allow you to borrow up to 100% of the purchase price with no deposit at all in some lender products, or to reach the 20% threshold without saving the full 20% yourself. The risk to the guarantor is real and needs to be understood clearly before this structure is used. If you default on the loan, the guarantor's property is at risk. The guarantee should be limited in scope, covering only enough to bridge the LVR gap rather than the entire loan, and should be removed as soon as your equity position allows, typically once the property value or your repayments bring the loan below 80% LVR. The Bank of Mum and Dad is now the 9th largest mortgage lender in Australia by volume. This structure is being used across the country, formally and informally. Understanding how it works protects both the buyer and the family member providing the security. So here's where it all lands. If you're a first home buyer in 2026, the 5% deposit pathway is the most accessible entry point into Australian property ownership in the history of the scheme. But accessible doesn't mean automatic. You still need to choose the right property. Budget correctly for total purchase costs. Understand the loan structure you're entering. And make a clear-eyed assessment of whether getting in now versus saving longer makes sense for your specific market. The government has opened the door. Walking through it confidently still requires doing the homework. If this gave you a clearer picture of how the 5% deposit pathway actually works, hit the like button and subscribe. I'll see you in the next one.